Hello there, dividend growth stock investors. Colby, the DGI Crab, coming to you today with a video that's not about stocks, but more about a platform. We're going to be talking Robinhood, the most infamous of the online no fee trading platforms out there. Want to talk about why I use Robinhood, go over some of the controversies so you'll know I'm not coming at you from a biased perspective. And I'm curious to know if any of you all out there utilize Robinhood, what your thoughts are, and any reasons that you may have that I don't cover in this video for why you don't like or don't utilize the platform. No, I'm not talking individual stocks today. I will say that I'm not a licensed professional financial advisor. And the opinions discussed within this video are just one crab's opinion. You should always do your own due diligence before investing in any security, or for that matter, picking a platform for which you can buy and sell your securities. So, just full transparency. So, I have a few different places where I invest my money. I have a 401k at my work. I have a small side brokerage in SoFi, in which I'm doing a series for this channel where I'm investing $5 into 8 different dividend growth stock ETFs every single week. And then I utilize Robinhood both for my primary brokerage and my Roth IRA. So the bulk of the money that I have invested actually is invested in the Robinhood platform. So let's talk about it. So for anyone that's not aware, Robinhood was founded April 18th, 2013 by Vladimir Tenev and Baiju Bhatt. Their mission is to provide everyone with access to financial markets, not just the wealthy, hence the name. Prior to Robinhood and several copycat trade platforms were launched, but Robinhood was kind of the front runner in this. It was a very common place for you to be charged anywhere from $5 to $8 per trade transaction. So whether you're buying or selling, that was usually about the growing rate. And prior to about 2005, 2006, it was even more expensive than that to make trades. So this really revolutionized trading, not only by allowing people to get a brokerage account without any maintenance fees or monthly costs or anything like that, but allowing people with small amounts of money to be able to go in and invest. I would not be able to do my $5 a week into 8 separate ETFs previous to an app like Robinhood came about, because I'd be getting charged $5 to $8 on top of each of those $5 transactions in order to do those. So typically prior to Robinhood, you had to have a larger chunk of money saved up to do a lump sum investment to make the trade fee not absolutely eat you alive as far as the transactions go. So the app really does have, I think, a very appropriate name. Now, I'm going to go through the controversies and the criticisms of the Robinhood app. I just pulled all this stuff from Wikipedia. So if you want to go to the Robinhood Wikipedia and review any of this stuff in more detail, you are certainly more than welcome to. So, payment for order flow and order execution. Robinhood receives most of its revenue from payment for order flow and relies on this source for revenue more than its rivals. And this has been criticized as a backdoor commission, and it's also been criticized for undisclosed markups on cryptocurrency transactions. So how does this affect me as a dividend growth stock investor? Well, maybe a little bit. Anytime that I make my weekly transactions, uh, there is some money that is going to Robinhood that I don't necessarily see. If you look at the price of a stock or ETF live on Robinhood versus anywhere else like Seeking Alpha, Yahoo Finance, or whatever, the amount is generally just a small fraction of a percent higher on Robinhood than it is actually live on the market. So if I'm making crazy amount of transactions, if I'm doing hundreds of little tiny transactions every single week, the amount of Robinhood is making off of me is going to start adding up. But I'm not technically seeing it, first of all. And I wouldn't recommend anybody make that large amount of transactions over the course of a week anyway. Just pick a handful of transactions that you're going to do and stick with a plan. And this, I don't think, should affect you really whatsoever. And it's still a much better alternative than getting charged $5 to $8 per transaction. Another is lack of product availability. They don't offer trading in mutual funds, high risk penny stocks. They have significant restrictions for trading options on the actual expiration date. And their IPO offerings have not performed particularly well. None of this impacts me whatsoever as a dividend growth stock investor. I could care less about any of it. Security breaches. So in July 2019, Robinhood admitted to storing some customer passwords in an unencrypted clear text format. Not good. October 2020, they had almost 2,000 accounts that were compromised to hackers. And in 2021, a voice phishing scheme on a Robinhood employee resulted in about 5 million customers having their email addresses stolen. So it's believed, by the way, that Connor Brian Fitzpatrick, the owner of Breach Forums, who was responsible for the 2021 FBI email hack and was arrested in March 2023, was responsible for the breach. So breaches and security are not good. But honestly, while this isn't letting Robinhood off the hook, there are a lot of companies that have had problems with cyber security breaches. This is not a problem unique to Robinhood. This is just a problem that exists today. And companies and governments and even individual people all are having to take a lot more precautions to keep their data and their security safe. Infinite leverage glitch. This was in November 2019. The infamous Wall Street Bet subreddit shared a glitch that allowed Robinhood Gold users to borrow unlimited funds via selling covered calls. That not a good situation. This was a loophole that got closed very shortly after it was revealed, and the accounts that exploited it were suspended. And then there were some accounts that recorded six-figure losses by using what Wall Street Bet's users dubbed as the infinite money cheat code. So this was a tech oversight, and it was immediately corrected. So since the end of 2019, this isn't even something that you can access or worry about as a user anymore. Mobile app outages. So during the COVID-19 pandemic in March 2020, very likely due to high trading volumes, Robinhood suffered a system-wide all-day outage that prevented users from accessing the mobile app during the largest daily gain point of the Dow Jones Industrial Average. So they did offer compensation on a case-by-case basis. They had a second system-wide outage on March 9th, so March 2nd and March 9th of 2020. They've not had one of these since then. And if anyone was around investing during the COVID pandemic in March of 2020 would realize that, I mean, there were points where the entire stock market just shut down because of the volume of sell-offs that were happening. So while again, this isn't necessarily a pass for Robinhood for their tech not being able to handle the high trade volumes, sometimes companies just have to get their ass kicked and understand the weaknesses in the technology so they can go in and make the improvements, which I'm hopeful that Robinhood has. If they have another outage like this at some point in time, then I'm going to be a lot more critical of them on this particular point. But at that point, the app was still just about 4 years old, and this was the first major financial crisis that it had to deal with massive sell-offs. So I'm going to give them a pass on this one. Again, if they have trouble with it again, I'm going to come back hard and really start crabbing at them. But again, I can exercise a little bit of grace on this one, just knowing that this wasn't the result of any chicanery or anything illegal going on. It was just they're still fairly new tech getting its ass kicked for the first time in an environment that it just wasn't ready for. The suicide of Alexander E. Kearns in June of 2020. So this was a sad story. This guy, Kearns, committed suicide after he saw a negative cash balance of $730,000 in his Robin account. He was utilizing margin trading, and it was likely a bull spread, according to the article. It was later discovered that this balance was not complete as it did not reflect settlement of an offsetting position. In his suicide note, Kearns accused Robinhood of allowing him to take too much risk. I, you know, I'm not going to speak ill of the dead here in this situation, but to me, this is blaming a tool as opposed to blaming how a tool was used. So if I am in a situation where I have a friend or a family member that, God forbid, but if they commit suicide by shooting themselves, can I be mad at Smith and Wesson for manufacturing the gun? Or if they take a bottle of pills, can I be mad at the pharmaceutical company that manufactured the drug? I can't be mad at a tool. Ultimately, people make individual decisions, sometimes for the good, sometimes for the bad, and perhaps it was not the greatest thing in the world that somebody that couldn't afford the leverage that they were going in and setting up within the app were able to do that. So that's probably fairly reasonable criticism. But what you have to understand is if you're using leverage on your investments, you have a very good chance of losing big. Again, if I take my life savings into a casino and put it on the roulette wheel all on black, I have a chance of doubling my life savings. I have a chance of coming away with zero. Is it the casino's fault for existing? You tell me. I don't think that it is necessarily. Next, there was a violation of anti-money laundering rules. This was around their cybersecurity and specifically cryptocurrency related actions. They also applied a bankruptcy tag very briefly to the AMC stock ticker for 3 minutes. As a dividend growth investor, neither of these stories impact me whatsoever. So again, these are a couple I just could care less. Gamification accusations. So this is kind of an interesting one. It's that, again, it's kind of blaming a tool, but it was just an administrative complaint. Long and short of it is that Robinhood made stock trading into gamification. It was too fun. There was too many celebratory things like confetti and balloons and things digitally going across the screen whenever you made a transaction or deposited money. I understand the argument, but to me, I don't think it's some great corporate sin to try to make investing fun. I think investing should be fun. Um, Now, if they're if they were doing some sort of practices to encourage you to make more and more trades in volume, so they would get more and more money, I would probably have some serious criticism of that. But to me, what they were doing on the app at the time was just trying to make the experience enjoyable. And if that caused people to trade more, then I think that's more of an indirect effect. And then there's the GameStop short squeeze. So, I'm not going to go into this. There's multiple movies and documentaries and whatnot about the GameStop short squeeze and the actions that Robinhood took during that point in time. I think that the executives at Robinhood were faced with a handful of really awful decisions that they had to make, and they had to make one. So when they shut down the app or turned off the sell button temporarily, was that a bad choice? Yeah, maybe. I think some of their alternatives that they had available were also really bad choices. So I think they were just in a lose-lose situation. You can read up more on that or watch the movies if you want to know more, but I don't have a lot to say about it. It didn't shake my security. But ultimately, Robinhood was largely responsible for killing high commissions. Before, as I mentioned, you were being charged anywhere from $5 to $8 for making a trade. Bank of America estimated that they were generating 28% of its revenue from commissions from TD Ameritrade. No longer. So that's why I'm a fan of this app, and I'll continue to use it as my primary brokerage. What do you